Oh, hello. It's Dr. Jeff Holm again. This is the fourth lecture on financial statements, and today's lecture will be particularly on the ratio analysis. All right, first of all, ratio uh, basically ratio means the financial ratios, which are based on the financial statements. The the variables in the ratio are particular line items in the financial statements, and it's also called the fundamental analysis. I mean, the broad, extended definition of fundamental analysis doesn't include only the ratio analysis. It can be more extensive, but the core of the ratio analysis is basically a core of the fundamental analysis is basically the ratio analysis, right? So what ratios are we talking about here? Well, there are five categories of ratios, right? First category is profitability category, right? Don't pay attention to uh, the particular line items in each category. Just at this point, just look at the bold font, bold print, which are basically the category names. So the first category is profitability category. So there are several ratios in the profitability category. And then there is a market valuation category. But again, we will come back to market valuation later, although it is listed as the second category here. But actually, this will be the fifth category that we're going to look into. And then the second category is liquidity. Okay, this is getting a little chaotic. So liquidity category, right? Liquidity. And then the third category is asset management category, right? And the fourth category of ratios is the debt management. Okay, and then fifth category will be the market valuation, right? So if I put it on, let me use the whiteboard. Okay, let me get back to collaborate and then whiteboard. Okay, so let me use pencil. So five categories. The first category is profitability. Profitability. And in each category, there are like anywhere between 2 to 5 ratios in each category, right? Some categories have only two. Some categories can have like 3, 4, 5. But the most broadly used or most commonly used ratios are in each category are generally about 2 to 3, right? I mean, those are more fundamental ratios. That's why they are the main ratios in each category. So we don't have time to go over every ratio in each category. So we're going to look into basically the major two ratios in each category. So let me, you see, I'm putting a bracket under each category, and I'm putting two, A and B, right? So okay. So for example, in profitability category, the two major ratios are ROA, return on assets, and ROE, return on equity, right? In liquidity category, the two major ratios are current ratio, current, and quick ratio. It's also called quick ratio or acid test, right? It's so hard to write it. So I'm gonna, okay. Okay, acid test. So third category is asset management. Management. I'll just abbreviate. That's management, right? And two major ratios in this category are first, inventory turnover ratio, inventory turnover, and then fixed assets turnover ratio, fixed assets. Oh, guys, so you could understand how difficult it is to write with a mouse. Now, fourth category is debt management. Debt management category. And the first, the first one of the two major is called times interest earned ratio or cash coverage ratio. Times interest earned or coverage ratio. Coverage, right? Now, some of you might wonder, if it is times interest earned, shouldn't it be T? Why is it X? Now, this is not X. This is literally times, right? Multiplication, right? The multiplication sign, right? The multiplier. So how many times? That's what it means. It has nothing to do with the chronological time. It just means, how many times, right? So that's why I use that. Okay. The second one is called total debt to total assets ratio, or just simply debt to total assets, or just debt ratio, or leverage. It's also called leverage ratio. Leverage. Well, I could show you. I guess I can project the PowerPoint file, but it doesn't. It's the same table I have on the Excel, so it could be distracting. So please bear with me. This handwriting is not my actual handwriting; it's the mouse. So it looks very. It looks crazy, but you can tell. First category, profitability. Second, liquidity category. Third, asset management category. Fourth, debt management category. The fifth category is what? Market valuation. It's about actually valuation of stock, right? Market valuation categories. And then the first one is price earnings ratio. Price earnings ratio. The second one is market price to book value ratio. Market to book ratio, right? All right, so I have listed two major ratios in each category. So we'll be mainly looking at these, 10 ratios, right? So let me, go back to, before we go back to Excel, right? So if you're okay with this, I'm gonna have to erase because I'm gonna have to write it on the I'm gonna have to put the ratios, the formulas for each ratio, right? And so I'm gonna clear everything. Now, the first in the profitability category, the first thing is return on assets. So what does this mean? Well, now think about it. Return means, net profit, right? Or EAT, right? Over total assets, right? So now think about it. How did we define assets? Remember, not just what you own, what you owe, that type of definition, right? Or assets are assets equal liabilities and equity. Yeah, that's all correct. But most critical aspect of asset, right? What is the reason for being, or what is its reason for being, or what's the existential reason for assets, or what's the sole purpose of assets being, right? Why do the assets exist? We defined it, right? On the third level, assets must have income generating capability, right? We defined it as that. Think about it. The assets, like especially the fixed assets, like real assets or physical assets, right? Non-current assets, right? Long-term assets. It goes by so many different names, but they all mean the same thing. Plant and equipment, land and building, those are plant and equipment, right? Those are fixed assets, right? What is the reason for their existence? Why do you have plant and equipment, right? It's because they have no reason for existence if they don't generate any income. Isn't that right? For that matter, the entire total assets reason for existence is exactly that, generating income, right? So the total asset size, right? The size of total asset, which is in dollar value, expressed in dollar value, right? The bigger the size of the total assets, um, the bigger the production capability, right? The bigger the production capacity. The bigger the production capacity, the bigger the output. The bigger the output, the bigger the market share, right? In other words, the greater uh, plant size translates into a greater production capacity, which translates into greater output capacity, and so on. In other words, um, the so the entire business is, I've been telling you, is a vessel, isn't it right? It's a machine. It's a cash generating machine. I mean, some businesses are less productive or less efficient, but the most lean and mean, right? Most efficient business or most productive business would be the most profitable business, and the most profitable business and most efficient business, most profitable business is a most efficient cash generating machine. Isn't that right? The most productive and most profitable business must be the most lean and mean business with the most crucial efficiency, most even cruel efficiency, right? Cruel efficiency, right? So, in other words, what does that mean? Uh, so the return, in other words, the profit from that business would be uh, better than anybody else. Make sense? In other words, the net profit or EAT for its asset size would be high. Okay, makes sense. In other words, this ratio would have to be high if it is uh, a cruelly efficient, lean, mean, income generating machine, right? Then this ratio would have to be very high. Isn't that right? Don't you think? Also, think of it this way. Suppose you are like, 6'2" and 200 pounds, and you're full of muscles. All that, 6'2" structure, a 200-pound structure is just bone and muscle, full of muscles, just all muscles. Then what do you think that 200-pound muscle can do? Whatever it can do. I mean, it can lift weight. It can lift, like, 300 pounds, 400 pounds. That, 300, 400 pounds that your 200-pound muscle and bone can lift is the output, right? It's the output of your plant and equipment. Isn't that right? That makes sense. This analogy, right? Does this analogy make sense? But look, whatever it can lift, I'm sure the 200-pound, 6'2" structure, right? For a 6'2", 200 pounds full of muscles, will be capable of lifting more weight than just 200 pounds full of fat. Right? Makes sense? Another guy is also 6'2", but 200 pounds, but or let's say 5 foot tall, but 200 pounds full of fat. Right? Which guy would produce more output? I mean, in terms of doing work, right? Lifting weight or whatever. It goes without saying, right? So the return on assets is a very basic measure of the efficiency or profitability, right? Efficiency of that lean, mean, cash generating machine is, in other words, profitability of that business, isn't it right? Of that company, right? So Return on assets is measured basically, this is the ratio between uh, profit and total assets. Now, but then again, let's think about it. We can consider this as a output to input ratio, isn't it right? This is the output, this is the input. Now, what in the world does a better job to measure the efficiency or the productivity, right? What else can do better job of that, right? Other than the output to input ratio, right? A very good example of output to input ratio is fuel economy, right? What's the fuel economy? It's gas mileage, isn't that right? And if you think about gas mileage, that's exactly output to input ratio, right? How many miles did you get for per gallon? Now, how do they measure fuel economy? Mhm. Gas mile. How do they measure it? It's simple. If your car has 20-gallon tank, right? You fill up 20 gallon, right? You fill up 20 gallons and drive until you run out. And the distance you traveled, right? If you covered 600 miles on 20 gallons of gas, then what's the gas mileage? It's 30 miles per gallon. Isn't it right? The higher that ratio, the higher that number, the better the fuel economy, right? Makes sense? The better the gas mileage, right? That is a typical example of output to input ratio. Another example. Well, everybody intuitively understands, how much it costs to uh, go to college and get, a bachelor's degree, right? Of course, uh, if you have, if you're wealthy, you have, or you got a scholarship. I mean, you're very smart and you got a very good scholarship, or you're either that or you're very wealthy. You could go to like Ivy League schools, and Ivy League schools, they cost about $60,000 a year, 60K. So for 4 years, that's going to be 240K, right? But you're all at CUNY because um, you can't afford like 240K just to get a bachelor's, and you have more like more conscious of fuel economy, right, or gas mileage, right? Because CUNY costs at best about at most about 10K a year, right? So for over 4 years, if you're in-state resident, citizen, or in-state resident, even if you're a citizen, if you're not a New York State resident, you don't get in-state treatment. But if you're an in-state resident, then you pay about $10,000 a year, right? So over 4 years, it's going to be only about 40,000, or a little more than that, right? But then let's think about it. You suppose you went to Ivy League and it cost you 240,000, but you studied something like you majored in something like philosophy. You majored in something like art history, or I don't know, history, or but if you went to Princeton or Harvard, Yale, in even in those majors, you'll still relatively do well. I mean, although it's very competitive to get a job, but for example, you studied art history. Those people will generally get a job as curator at a museum, but those jobs are not really based on your uh, knowledge or competency or abilities. Those jobs are actually those jobs require connections, right? If you're well connected with wealthy and powerful, then uh, you get those jobs, and they are comfy, posh jobs, but posh, right? And then, uh, but to if you have graduated in like in those with those degrees, right? Um, your family background would also blend in with those, wealthy and influential, right? Uh, you'll be, your parents will be, hobnobbing with the other wealthy and powerful people. So through connections, they land a job like that, and through their connections, they thrive in that profession. Uh, so that's not the kind of life you're in. You have to really make it on your own um, nits and grits and abilities and brain, right? So that's probably why you're in this class in the first place. But think about it. You're not that well connected. You're not from that wealthy, powerful family, and you studied like philosophy or art history, even from Ivy League schools. Um, you don't really. It's not likely you'll get a job that will make you live very comfortably, right? Um, it will be still a very difficult life because anyway, think about it. Even from Harvard, you studied philosophy. What kind of job can you land? Huh? You probably teach at middle school. That would be possible, making about 30 to $40,000 a year. Let's say $40,000 a year, right? That's the output. Think about it. How many years will it take to just to break even, just to recover what you invested in your um, Ivy League education, right? It will take 6 years, right? Without spending any of it, right? Just to recover that 240,000. That's very low mileage. You understand? It's very low return on assets, right? But on the other hand, you go to CUNY and you study, economics, finance, and things like this, and you did very well. You have like, 4 point, close to 4.0 GPA. So after graduating, land a job with Goldman Sachs or JP Morgan. I'm not a big fan of these Wall Street, wolves, right? But uh, if you're very brainy, you land a job there and they pay you very well, right? So, I mean, if you land a job in investment banking, you'll make probably, something like, 150 to $160,000 a year, the starting salary, right? Of course, that's the starting salary, but that would be the starting salary in the investment banking. But your life uh, cycle is very short there. And besides, you have to work like, 16, 18 hours a day, right? Without any weekend. I mean, maybe you can take a Sunday off, but, basically, Sunday you'll have to sleep the whole day through, right? But either way, I mean, let's say because I'm not a big fan of wolves of the Wall Street, right? Let's say still, you with finance degree, you land a job in some um, finance profession, at least you can make, about 60,000 at least, right? Uh, so then what does that mean? I mean, throughout 4 years at CUNY, right, it cost you 40K. But as soon as you graduate and land a job, you more than break even in just the first year, right? And what's going to be the 4 year salary, right? Then simply, 6 times 4, 240,000. And take the gas mileage, take this ratio for that, right? So the ratio would be 6, isn't it right? And this is simply, you don't need a fancy math. It's just logic, right? Very uh, fundamental mathematical logic, basic mathematical logic, right? So that's what it measures, right? Uh, okay, you get that? The second ratio is ROE, return on equity, ROE, right? Return on equity. So what is return on equity? Return on equity is, once again, profit or, right? Net profit, right? Over equity. Okay, please bear with me. It's hard to write with the mouse. Now think about it. Equity is part of the total assets, isn't that right? Also, profit belongs to whom? You think profit belongs to the company? You think profit belongs to the company? No. Profit belongs to the owners of the company. And who are the owners? Equity holders, right? You say shareholders. Yes, another name for shareholders, stockholders, is equity holder. Equity is the owner's capital, isn't it right? So profit only belongs to the equity holders. Think about it. Profit. What is a company? A company, I've been telling you over and over, company is an inanimate entity. Company doesn't have consciousness, right? Conscience. Oh, consciousness, I'm sorry. The company doesn't have any awareness of itself, right? Company is just a legal structure, right? Legal entity, right? Legal person. But the company doesn't have any, it's not even an artificial intelligence, right? It's the people, right? The management who runs the company. And the management is the owner of the company, you think? No, management is not the owner of the company. Management is hired by the owners, right? You understand? Management is hired specialists to run the company, right? Hired by the owners. And those owners who hire them are basically the board of directors. Board of directors are large shareholders, right? Who represent the average shareholder. Look, actually, they don't represent. I mean, in terms of structure and in terms of the system, yeah, they are representing the average shareholder. But look, I've been telling you over and over. I used to be an Apple shareholder, but I had only 10 shares. What is 10 shares? It would be like 0.00000000001%, right? Completely anonymous owner, minority shareholder, right? The only thing I share in common with the large shareholders is that I benefit if Apple's stock price goes up, and I suffer if Apple's stock price goes down. But think about it. Between the large shareholder and minority shareholder, that's the only common thread. They don't know each other. They don't have to know each other. and I don't care because my involvement in Apple is very shallow. As long as Apple stock goes up and gives me a good return, I'm happy, and my relationship with Apple, it will be easily severed when I sell the shares. Make sense? But the majority shareholders are different people. They are not necessarily people, they are institutions, right? Like, because to own large shares, right? Huge amount of shares, then uh, an individual cannot do that, right? It has to be something like an insurance company or some financial institution, or right, someone who can mobilize uh, huge amount of capital, right, to own like 12%, 15%, 11%, even 6%, 9% of Apple, right? Makes sense. But anyway, the bottom line is uh, uh, the ownership and management are separate. Sometimes it can be the same because look, Bill Gates used to be the chair of Microsoft as well as the CEO, but he didn't. Uh, uh, he stepped down a long time ago, and there were like a couple of other people who succeeded to him as CEO. Now, also think about it. Steve Jobs was the CEO as well as the chairperson of Apple, but he got kicked out from the CEO position. Why? Because once again, it's the board of directors, and those who control 51% of the vote, right, can hire or fire the management, right? Makes sense? And if you control, I mean, you may not own 51%. One single person cannot own 51%, but let's say you own like, 7%. But you can pool together the large shareholders and who are friendly to you, right? And uh, control 51%, the controlling majority, right? Or controlling interest. Then you can appoint yourself, right, to the CEO position, right? And if your friendly uh, partners or friendly uh, forces in the board of directors, right? Friendly directors are all uh, have no doubt that you'll be the best person to lead the company, right? Uh, they will. I mean, let the chairperson run the company as CEO as well, right? So anyway, back to this, equity issue, right? Now think about it. Uh, the profit doesn't belong to anybody else, only to the equity holders. Now, if you think about it, what is total assets? Total assets, you all know, it's equity plus debt. Isn't that right? Equity plus debt. So equity came from the equity holders or the shareholders. Where did the debt come from? Debt came from the debt holders or creditors or lenders or bondholders. I've been telling you, they all mean the same thing. Bondholders, creditors, debt holders. Of course, bondholders are a special case of a class of debt holders. Uh, Creditors, lenders, they all. So think about it. Although the debt holders, debt is also part of the total assets, the profit doesn't belong to the debt holders, right? Profit belongs to only to the equity holders. Debt is another pillar that contributed to this output, but it doesn't belong to the debt holders, right? Debt holders got their cut, right? And what is debt holders cut? It's the interest, right? So if from if you have no problem holding that perspective, right? And think about it. Between, of course, the meaning of return on equity is exactly like meaning of return on assets. It's the productivity or the productivity of the equity, right? If all the shareholders, equity means the paid-in capital, right? If all the equity holders all chipped in together, let's say out of the $10 million total assets, let's say equity is $6 million. And you understand then the capital structure is 60% equity, 40% debt. And this $6 million was chipped in by the equity holders or the shareholders. And let's say if the company's at the end of year one, the company, let's say, made $1 million net profit. What's going to be the return on assets? Return on assets is going to be then, what did we assume? $10 million total assets, right? So then return on assets will be 10%, right? But then return on equity will be what? It will be greater than 10%. We know that for sure. Why? We're talking about the same net profit, 1 million, and equity is only part of the total assets. And total, we already assumed equity is 6 million, right? So what do we get? What do we get from this? What can we mathematically, right? By its own mathematical construct, return on equity is always bound to be greater than return on assets, right? When you are talking about the same company, I mean, of course, you compare if you compare return on equity with another return on equity, that would be, company X, company Y. Return on equity of company X, you compare that with return on equity of company Y, or return on equity of return on asset of company X with return on asset of company Y. You compare it like that. You can't compare return on equity of company X with return on assets of company Y, because it's totally, different companies, and you're talking about different categories. So if you compare return on equity with return on assets, that would be the comparison of these ratios of the same company, and return on equity is always bound to be greater than return on assets. And it's not a coincidence. It's just destined to be that way because of the mathematical construct of these ratios. Make sense? Okay. And also another way to look at it, you can, I call this output to input ratio, right? But also you can consider that as benefit and cost, right? To get this benefit, this is the cost you had to incur, right? In other words, this is the input is the cost, isn't that right? And the output is the benefit, right? It's like benefit cost ratio, benefit to cost ratio. Now, the second category is current ratio, right? Liquidity ratios, and number one in liquidity ratio is current ratio, liquidity category, right? From the name, it is quite obvious what it means. Current ratio means the ratio between current assets to ratio of current assets to current liabilities. Okay, so now let's think about it. As we did balance sheet, I told you that the source of funds to pay for the current liabilities is the current assets, right? Remember that? Current liabilities are the payment obligations that become due within 1 year. So you must have liquidity, right? Enough, cash flow or current assets to cover that, right? Now, so then uh, you might wonder, oh, then if we have just enough current assets to cover current liabilities, we should be okay. Uh, you're just barely okay. Why? Think about it. What if you have just enough current assets to cover current liabilities? What is this ratio going to be? It will be just one, isn't that right? But if the ratio is one, what does that mean? You have no working capital left after making this payment. In other words, didn't I tell you another name for current assets? There are many names: liquid assets, right? Short-term assets, right? Also working capital, right? Why is it called working capital? Well, that's the capital that is needed to support the uh, the operation, right? I mean, the company will generate revenue when they sell their first batch of finished goods that they make, right? But until then, you have to have some uh, money to uh, support the operation, right? Support the production and operation until your first round of revenue comes in. And when the first round of revenue comes in and it can cover for all these expenses, then CGS and OPEX, right? Um, then the company is viable, right? But if the company doesn't have enough working capital, then and the revenue, sales revenue is very meager, right? uh, the company cannot be viable if that's the case, right? But anyway, what I'm saying is if this ratio is one, you just barely made it and you have no working capital left. And if you have no working capital left, you cannot support the next round of production, right? So that's the ratio being one is not good enough. At least the threshold, the bottom line for this ratio is two, right? Greater than or equal to 2, right? So that means, right, uh, even after paying for all the current liabilities, you will still need to have as much left as the current liabilities, which can be used to finance and support the next round of production, right? And operation, right? So this is the threshold. But once again, just because you have made the threshold, you're okay. But you're just okay. Uh, but whether you'll have to also compare your own ratios with the industry average, right? Because if you although you are okay, but if on average the industry's current ratio is 6, you are way below, far below industry average, and that's definitely not good. That makes your company look inferior to other companies in your industry, right? Makes sense. Um, this is just the minimum, minimal threshold. All these ratios will need to be compared with the industry average. Okay. Now, the second ratio in the liquidity category is the quick ratio. I told you, quick ratio is also called acid test. Why is it called quick ratio? Now, you remember the current assets, the line items in the current assets. Current assets include cash and cash equivalents, promissory notes, marketable securities, and promissory notes, right? And accounts receivable and inventory. Now, I've been telling you of these like 5 categories, right, in the current assets, and I've been telling you all 4 of them, not the fifth one, but all 4 of them are quite liquid. Cash and cash equivalents are already, you know, as liquid as it can be. Marketable securities, they are liquid. It goes without saying. You can easily sell stocks and bonds and turn it into cash. Promissory notes and accounts receivable, they can be factored, right? Remember factoring. Now, what about, so they can, it doesn't take time to liquidate, right? Those turn into cash, right? Those liquid assets, right? But what about inventory? Well, inventory can be liquidated, but it takes time. It may not be done instantaneously like other liquid assets or financial assets. So if you have to make payment, if you have payment obligations that become due very urgently, right, then you cannot rely on inventory, right? Because inventory will take time. So quick ratio means only the quick assets, the ratio between only the quick assets and current liabilities. So what is the quick assets? Is simply current assets minus inventory. Okay, that's called quick assets over divided by current liabilities. Okay, and then the threshold for that ratio is greater than or equal to 1. Now it can be 1, right? Now you see the rationale behind it. The rationale is once you meet the payment obligations with quick assets, urgent payment obligations, you still have inventory left. So by liquidating inventory, which may take time, but you can still, all the urgent fires have been extinguished. So you can support your operation and production, right, by liquidating inventory. Okay, that makes sense. So we need to, the next category is asset management. And let me clear all this because I'll have to. Okay, in asset management, the first thing was inventory turnover ratio. Okay, what is an inventory turnover ratio? There are 2 formulas. I mean, it's not different formula. It's the same formula, but depending on what type of industry you're in, you just simply use the model that fits your industry. It's basically a revenue over average inventory. Average inventory. Okay, but this is for retail business. And if it is manufacturing, Okay, again, inventory turnover ratio for manufacturing. It's then CGS over average inventory. Average. And what is average inventory? Then average inventory is revenue right here. This beginning inventory, basically beginning inventory plus ending inventory divided by 2. Okay. Now, I'm not going to write it again because, it's simple, the same thing, but, CGS here, right? Right? The same thing by 2, right? That's average inventory. Now, why are they different between these two industries, right? First of all, inventories must be expressed in terms of cost. That's the preferred way of expressing inventory. But especially in manufacturing, all inventory is expressed in terms of cost, right? Because think about it. In manufacturing, you have raw material, you have goods in process, and you have finished goods, right? Although you have finished goods as part of your inventory, but the finished goods won't remain on site, at the manufacturer's site for long, because once it is produced, then they should be shipped out, right? And will be in the retail outfits, right? So most of the manufacturer's inventory would consist of raw material and goods in process. And how can you put a retail, value on those things, right? You have you you have basically all your inventory is expressed in purchase cost, right, by you. Now, but in retail, suppose you have, in retail, everything is merchandise, right? All your inventory is finished goods, merchandise that is ready to sell. So you can put, you can express it in, selling price as well, right? Because, but of course, for tax purpose, retail businesses must also express inventory in terms of cost. Okay, because if Best Buy bought, the computers from Dell at $300 per unit for, but they sell it for $500. All these computers have, a retail price, commercial value of $500 on it, right? But think about it. If you can, so if you have 1,000 units of these computers, you can express the inventory value in terms of cost. So 300 times 1,000, 300,000, or you can express them in terms of, selling price. If it is 500, 1,000, so 500,000. Now, suppose, what do you think is the, what do you think they would prefer if, for example, if there was a fire in the warehouse or in the store and it just, everything burnt down, right? You lost, all your, computers. Of course, you will file an insurance claim form. And on insurance claim form, what would you put as the value lost, right? Would you put, $300,000 there or $500,000 there? If you say $300,000, you are too, you cannot be in business. You are too altruistic. You're doing a favor to the insurance company, right? Look, think about it. Insurance companies, by their own, nature, right? By birth, they are not. They don't exist to do you a maximum favor. They would do you the least. They would pay out the least. They will do their best to downplay the value of or right? Under value your insurance claim, right? And from your standpoint, you lost the merchandise that could have been sold for $500,000, right? That's your damage from the fire, right? And even if you put in $500,000 as the for your claim, right, or the amount, the value lost, the insurance company will do their best to knock it to knock down, right, or to beat down that, right, that value. So there's no reason. Well, anyway, that's why the retail business can express their inventory in selling price, because they are merchandise already that can be sold readily, sell at the selling price. Okay. Well, the time's up. We haven't completed this asset management category. We have another ratio here, which is fixed assets turnover ratio. And so we're going to talk about that. We're going to pick it up from there in the next session. Well, thanks for watching. End video.